so glad to have you join us today. I'm Lou Ann Fulmer. Imagine for a moment that your money could talk. What would it tell you? Would it be worried that you don't have enough saved for retirement? Millions of people are retiring earlier than expected, feeling a little financially vulnerable. And the number one fears still remain the same. Have I saved enough? And how am I going to cover health care in retirement? So today, Andrew's going to discuss how you can make sure that you are prepared so you can weather those storms in retirement. Here's your phone number that you need to remember for our show today, 800-848-8768. Again, 800-848-8768. You can call Andrew for a complimentary visit. He's offering that to you today. Also, find us online anytime on their beautiful website, swan-capital.com. That's swan-capital.com. And Andrew, big hello to you.
Hey, I'm so excited to speak with you about today's topic.
Oh my gosh, yes. We have a lot to get to today, a whole lot to get to. And as I mentioned about all the people that are going to retire, every year they have estimates about how many people are going to retire. But thanks to the pandemic now, the projections have been off by 1.7 million,
Wow.
Andrew. And so that's how many additional workers have actually retired this second quarter of this year. So a lot of these studies indicate that about half of the workers are, like I said, are thinking they're not going to be able to maintain their standard of living. Could we be facing a retirement crisis in the United States?
Well, I think we definitely could be, certainly. And there's many reasons why. I think it feels like there's a retirement crisis because Americans have been handed the heavy burden of creating their own pension in retirement. The traditional retirement is retired. You know, where you used to have a Social Security, pension, and investment income, that three-legged stool, has now been depleted where it's only Social Security and investment income. And so the biggest mistake I see that Americans make is they think because they've made money for all these years, they believe it takes the same skill and expertise to manage their wealth over a lifetime. It really does take a specific skill to manage and keep wealth, and it takes experience and specialties to manage that wealth for a lifetime. So, unfortunately, there may be a retirement crisis with this additional 1.7 million Americans not even estimated before last year retiring ahead of time.
Right. So, okay, let's go over some of the big financial risks that we really should be aware of, just in case we have to retire earlier, or if we are just getting ready to retire. What should we be aware of?
Well, I think the first thing that we definitely want to always talk about is planning for longevity, planning for a 30-year retirement. I just met with a soon-to-be retiree, Susan, who is retiring in 6 months at the age of 62, which is really exciting. But getting to know her, I found out that her parents are still living in their 80s. And that means that she can live for a long time based on her genetics that she's going to inherit from her healthy parents. And that means that she could realistically live a 30-year retirement. And it takes a lot of assets to last 30 years. And so remember that retirement is a new theory that we've come up with. I mean, for most of human history, people did not, retire for 30 years or 20 years. Most people worked their entire lives, then passed away shortly after.
Oh my gosh. So I'm 62, Andrew. And I'm like, there's no way I'm retiring right now, but that's amazing. I know people who are, and that's very cool that they can do that. But again, it's kind of scary.
It is scary. And we have clients that retire at 55 and 75, which just means when you do finally retire on a Friday and walk into retirement on Monday, that you have enough assets that you don't have to go back to work. That's not what anyone wants to do.
Nobody wants to do that. So, for people who are feeling vulnerable about their future, how can they get a financial checkup?
Sure. A lot of times, Luann, people kind of jump right into retirement. I have a feeling that 1.7 million Americans, additionally, that are retiring, probably thought, hey, some of my friends are retiring. Maybe I'd like to retire, and they jump right into it, not thinking, am I really prepared for that? And I think a lot of times families don't go see a financial professional because they think it's going to be like a trip to the dentist. We're going to point out all their cavities and all the ways that they should have been flossing and that they should get on a budget, and maybe that they are going to be told that they haven't saved enough for retirement. No, what we are going to do is probably pat you on the back on a lot of things that you're doing really well, but bring to your attention some ideas and some strategies that can serve your family and give you a better sense of if you're on the right track for retirement, and really give you a more holistic view of your finances, not just looking at the investments per se, but looking at how do your investments tie into your estate planning, your tax planning, as well as your income plan for retirement.
So, Andrew, you kind of offer something like a financial checkup, don't you?
We do. We call it a sleep study, which, everyone likes to sleep. Not everyone likes the idea of going to a sleep study, finding out if they have sleep apnea. But we call it a sleep study because Swan Capital, our company, was named after my goal of helping families sleep well at night. So our sleep study is basically a 1-hour complimentary visit where we give you a report card on your retirement readiness. So if you have all of your tax planning and most of your assets are tax-free, we may give you an A in that category. Maybe you have all of your legal documents done. We may give you an A in that category. But maybe when it comes to your retirement income plan and you're really not sure how you're going to bridge the gap between your expenses and your income, we'll give you a C on retirement income planning and share with you some of the ideas that can take that C and turn it into an A. So if you're listening, you say, Andrew, I would love to go through that. I'd love to make sure that I get all my questions answered. I'd like to make sure that I'm ready for retirement. All you have to do is call our 1-800 number. And we use a 1-800 number because we have 2 offices. We have an office in Daphne and we have an office in Pensacola. So give us a call at 1-800-848-8768. That's 1-800-848-8768.
And then their website, swan-capital.com. It's SAWN-CAPITAL.com. Head there, find out even more about Andrew and his team at Swan Capital. Andrew wants to help you feel confident that your retirement nest egg is going to be set up for a long, flourishing retirement. They can help you do that strategically. So we just thank you so much for joining us. This is What Your Money Would Say with Andrew McNair of Swan Capital. I'm Lou Ann Fulmer. So we know health care coverage is a huge concern for people in retirement. Medicare is there to help, but what blows my mind, there are some big things that it does not cover, Andrew. They call them head issues like vision coverage, hearing aids, dental, because so many things can go wrong if you don't have proper, dental care. That's why
That's right. Those visits to those dentists.
Yeah, right. Exactly. But here's the deal. There is a proposal working its way through Congress that could change some of that. But why don't you tell us about Medicare and the things it doesn't and it does cover?
No, absolutely. A lot of times people are very surprised that when they get on Medicare, they think all of their health insurance coverage woes will be subsided when they get on Medicare. But that's not true. There's things that Medicare does not cover, such as eyeglasses, contact lenses, hearing aids, exams, dental procedures, all of those head issues that have to do with typically eyes, typically with teeth, as well as ears. And it is a startling statistic that, like you were talking about, that nearly half of Americans that are 65 and over didn't even visit a dentist in the last year, according to the CDC. And nearly 1 in 5 Americans over 65 have lost all of their natural teeth. So, of course, they need help with their dentistry, and I think it really makes a lot of sense that, this may be incorporated to Medicare because I think it would make it a lot simpler. So, again, a proposed change would add dental benefits to Medicare for the first time since this program has been launched since 1965.
Wow. And from what I read also was that the reason they didn't want to add it to Medicare, the Dental Association, was because they were worried about insurance and not getting paid enough and all of that. So anyway,
Sure.
I hope it can go through. But these are just proposals right now. Nothing has been passed. How do you help people tackle healthcare costs in their retirement strategy? Let's go over that again.
Exactly, Luann. Healthcare is complicated, and I would love for them to add dental to Medicare because at the age of 65, many families go from working, then they retire, and then there's typically a gap between their health insurance coverage and Medicare, and then they think that all their healthcare woes is going to be solved when they reach Medicare age. But then they have to look at, prescription coverage. They have to look at not only that drug coverage, but they have to look at dental coverage. And if they have eyes and ear issues, they're going to have to need additional coverage. And so I would love that the ABCs of Medicare become even simpler because, again, if it was just the ABCs, it would be that simple, but it's far more complicated than the alphabet. So if you're trying to decide between things like a Medicare Advantage plan and a Medicare supplement plan, what we do for clients is help shed light on the differences between the two, the pros and cons, so that our clients can make a more informed decision. Because once you go down one path, there's always pros and cons of each path.
Sure, of course. Now, there are all sorts of predictions right now about what might be coming our way in terms of volatility. So how concerned should we be about volatility in the future, and maybe how bad it could get? What are you telling people?
I think this is a really good discussion to have because we have been accustomed to, for this year, nearly 200 record hitting days where we're having record after record in the stock market. And it appears that the stock market nearly goes up every day. And that can make investors complacent. And that can make investors not think about the opposite side of the coin, which is volatility. And when there's a lack of volatility, investors typically have a tendency to take more and more risk, and they get comfortable, even though really it's not their skill that's making those double-digit returns. It's the tide that's rising. So think of it this way when it comes to volatility. If you live in Kansas, you have to be well aware of tornadoes, which can come out of nowhere quickly without a warning. They don't give you a heads up, and they're unpredictable, as we know. But here on the Gulf Coast, we have less tornadoes, but more hurricanes. And luckily with hurricanes, they last longer, sure, and they can be devastating on a larger scale potentially, but at least we have notice. We have time to prepare for that. And we've been, again, spoiled in the stock market with having very little volatility, very little headwinds that we're going against. But volatility is going to come back, I believe, with a vengeance. And sadly, it may not be just a tornado. It may be a longer storm that we have to be prepared for. And how you prepare for that is if you're 3 years from retirement right now in 2021, you need to make sure that your fiscal house is in order before those storms come up.
So then, what should people be doing to help protect themselves from the downside of the risk?
Well, you have to give your money jobs. So we use the fiscal house analogy. So that was perfect that I brought that up.
Yeah.
A roof account is an account that's correlated with the stock market. We need to have roof accounts because the stock market produces a lot of great returns that keep us ahead of inflation. But we also need wall accounts. Now, wall accounts are fascinating. When the market goes down, they go the opposite direction. They can actually go up when the market goes down. And people say, Andrew, that doesn't make sense. Everyone lost money in 2008. And I kind of joke and I say, well, obviously not everyone lost money in 2008 or March of 2020. Someone had to be buying the stocks that people were selling.
Yeah.
And it's the people that had foundational accounts and wall accounts. Now, again, wall accounts are things like puts and options on the stock market, private equity in a small business, things like index CDs at a bank, index annuities at an insurance company. I mentioned commodities. Anything that when the market goes down, it goes the opposite direction. And that's how you can be better prepared for a tornado if it's short volatility or a long-term hurricane. So if you're listening and you say, I would love to make sure that my fiscal house is in order. I would want to make sure that I'm protected from risk if I'm 3 years from retirement. How can I make sure that I'm not taking more risk than I'm comfortable with? Sadly, our industry talks about conservative, moderate, and aggressive, but there's more exact numbers that you can utilize, and we call that a risk score. So to take your risk score, all you have to do is go to whatyourmoneywouldSay.com. So the name of our show, whatyourmoneywouldSay.com/quiz. So if you go to whatyourmoneywouldSay.com/quiz, it'll give you a few questions that really help you determine what your risk score is. And then what we help clients do is we match your portfolio, what you're currently invested in, with your risk score to make sure that you're not on a roller coaster that you can't handle. So again, go to whatyourmoneywouldSay.com/quiz.
We still have a lot more to cover today, so stick around for more of What Your Money Would Say with Andrew McNair. Hey, you're listening to What Your Money Would Say, and I'm Lou Ann Fulmer here with Andrew McNair. He's president and CEO at Swan Capital right here in Pensacola and Daphne, Alabama, and he is here to guide you about retirement planning. And okay, so if we look back at the last 20 years of our lives, I bet there's a lot of things each of us, you and I, Andrew, anybody listening, can say, wow, I didn't see that coming, you know? So
That's true.
yeah, there were probably some really wonderful things that happened and then maybe some obstacles that got in the way. But this is kind of what it's like in the future, right? You can expect in 20 years from now the same thing happening in your own life. So let's talk about that. What would be some big unknowns for retirement?
Well, I think for retirement, these are the four things as an investor, as a soon-to-be retiree, that you always need to keep your eyes on. The first one is longevity. Again, we live way longer than we ever expect. I don't know what's wrong with the human condition, but we always are pessimistic about how long we're going to live. Even though our parents may have lived into their 80s and 90s, we think we're going to die in our 70s. I don't know why that is. Maybe we just don't want to proclaim it and then not make it. I don't know what it is. So we want it to be a surprise.
Yeah. We don't want to fail.
That's right. Number two is healthcare costs. Again, back with longevity is we hope for a long, happy, healthy life, but sometimes we do have some health concerns, maybe a knee surgery or shoulder surgery, and those healthcare costs can really add up in retirement. Number three is the performance on the market over time. We have no idea what the next 10 years of market returns are going to look like. But we know that it's going to be like what you were talking about, Lou Ann, opportunity mixed with difficulty. And it does go to those who, again, change. They don't just buy, hold, and pray. They buy, hold, pray, and move. And then the last is taxes. And that's why we work very closely with CPAs, because you want tax-free retirement income, not just taxable retirement income in retirement.
All right, let's go with that first one, longevity. Obviously, we don't know how long we're going to live. You know, that's an unknown right there. How do we know if we've saved enough? How do you help someone feel confident about that?
Well, if you read Money Magazine and Money publications, they're going to share with you multiple rules of thumb. And the problem with rules of thumb is they can give people false sense of securities. And that's really not good when you approach retirement, to have an idea of what you need to have saved for retirement and be sadly or rudely awakened. Instead, what you want is an actual plan. And that's why we use a 3-bucket strategy towards retirement income. And let me explain to you how that 3-bucket strategy would work. So you can do this at home, or you can have a professional help you with this. The first is we want to have the bucket that takes care of incomes 1 through 5. And this is why so many families have to put a pause on their retirement or have to delay their retirement, because they don't have the first 5 years of retirement mapped out and know where that retirement income is going to come from. Years 5 through 10, that second bucket, now that we know that the first 5 years are taken care of, that 5 through 10 year bucket, we can to have less liquidity because we know we're not going to need to access it. We can take more risk because we know we're not going to have to touch it. Even if the stock market were to crash or drop, we know we're not going to touch the second bucket for years 5 through 10. And that gives us a chance to grow that money better than we would for that immediate bucket in years 1 through 5. And then the last year bucket, even if I have a family that's completely risk averse and they don't like the idea of having any money in the stock market, in the 10 plus years and beyond bucket, the one that makes sure that you have a 30-year retirement potentially financially, we have to take a little bit of risk, utilizing real estate, utilizing the stock market, utilizing some asset that has risk. But again, if you know and you have a permission slip not to touch it for 10 years, that gives you the ability to take more risk than you probably would normally be comfortable with.
Right. Okay, so if we want to make sure our income's going to last, what would be some tools? You kind of were touching on it, but explain what specifically those tools are.
Well, I can tell you one tool you want to be very careful of, and that is be careful about annuities. Many people turn to annuities because at first they watch a commercial on TV that promises them that they can never run out of money if they utilize this asset class. And I can tell you, if it sounds too good to be true, it usually is. Every investment, if you look at stock market investments, CDs, annuities, they all have pros and cons. And what we do is try to make sure that clients understand the pros and cons so they can make an informed decision. So if you look at annuities, make sure that you're comparing apples to apples. There's three major types of annuities, and there's endless amount of companies. So obviously there's going to be details that vary from one to another. So let's start with the first type of annuity. That's a fixed annuity. Very similar to a CD, it's going to pay a guaranteed rate based on the years that you select it for. So a 3-year annuity, a 5-year, a 7, a 10-year, it's going to pay a guaranteed rate. So right now, if there is a MIGA, a guaranteed annuity of 3%, well, that would pay your family 3%, and that's based on how insured, how strong that company is. If it's an A-rated company, hopefully they'll be around for at least 5 years to pay out that guaranteed 3%. The next type, the opposite side of the spectrum, is a variable annuity. Well, use your context clues there. Obviously, the first word means variable. The market's going to go up and down with the market. I've had families actually tell me that own a variable annuity. They said, I don't think my money goes up and down with the market. And I said, it's a variable annuity. So it obviously does go up and down with the market. Also, you have to be aware of the fees in a variable annuity. I've seen just recently a new client had a variable annuity that paid 2%. I've had clients, very savvy investors, have a variable annuity that paid as much as 3.7% a year in fees. And then you have a fixed index annuity, which is basically a hybrid between the two. It's got principal guarantees. It's got, once your interest is credited, it has some guarantees. Typically no fees on that account. But again, you are tying your money up, and you have to be careful with fixed index annuities because you may tie your money up for 3, 5, 7, 10 years where you can only access 10% of your money. So if you are going to buy a house in 5 years and you put it in a 7-year annuity, you created yourself a dilemma because you can't get to all of your money without waiting 7 years. So before you buy an annuity, make sure you get a second opinion so that someone can make sure you're comparing apples to apples instead of apples and oranges.
And you give those second opinions, don't you? Complimentary.
We do. So in our Swan Sleep study, many times families have came in with a prospectus on a mutual fund. They've come in with annuity that they have a 30-day free look, which means they have 30 days to look at this annuity before it becomes in stone. And we've looked at this, and I've looked at annuity before, and I said, did you know how many fees this had? Or did you know that there's a better potential annuity that has better accumulation potential? And they said, no, this was the only one they showed us. And so, again, we were able to give that family an additional set of questions to ask, additional information points to make a good decision for their family. If you're looking for that same second opinion, all you have to do is give us a call at 1-800-848-8768. And when you call, leave a voicemail, and Suzette will call you the next week or Monday because we're not here on the weekends, and she'll say, hey, let's find that 1 hour time on your calendar that he can go through that second opinion with you before you make a major financial purchase. Again, that's 1-800-848-8768.
As you can see, Andrew and his team, they specifically focus on retirement, and they are innovative in finding solutions to help their clients live well during their retirement years. Let me guide you to their website, swan-capital.com, SWAN-capital, and that's 2ACAPITAL.com, and they are an independent firm, and that's why they can look at anything, and they can help you find solutions. And we thank you so much for listening to What Your Money Would Say with Andrew McNair. I'm Lou Ann Fulmer. So we always talk about how Fidelity estimates that an average couple retiring is going to spend around $300,000 on healthcare costs and retirement. A lot of money there, not even touching long-term care. So go over how you help someone plan for that, please, Andrew.
Sure. We'd be remiss if we never talk about health insurance and Medicare options when we're talking about retirement planning. And it's essential to make sure that you don't choose the cheapest health insurance option in retirement. And many times, families look at a Medicare Advantage plan because the premium is basically non-existent. And they say, well, obviously, I want the cheapest route. I don't want to pay a lot because I'm on a fixed income in retirement. However, maybe a Medicare supplement feels like a premium to you, and it means less copays and out-of-pocket expenses in the long run. And you say, Andrew, how do I make a decision? this is something you want to take careful consideration of and saying, okay, I understand with the Medicare Advantage plan, I'm not paying as much monthly, but I may be on the hook for those co-pays and those out-of-pocket expenses. Or do I want to make sure that I pay for more coverage with the Medicare supplement, I pay more monthly premium, but I don't have to worry about those out-of-pocket expenses? I don't know about you, Luann, but if I'm going to pay for auto insurance, for example, when I get in an accident or when my family gets in an accident, I want them to make sure that they have confidence that if something happens to them, that they're going to be covered. I mean, that's the whole point of insurance, is to have assurance.
That's true. I love that, to have assurance. As I mentioned, Andrew, the estimated cost of healthcare didn't include long-term care. How do we estimate that expense?
Well, we have to lift up every stone and look underneath it to make sure we're not missing out on benefits that our family could be eligible for. Give you a quick, for example, if you look at veterans benefits in this county, in Escambia County, in Santa Rosa County, if you look at Baldwin County, we have more veterans per square inch than nearly anywhere in the country. And many families have never heard about veteran aid and attendance, which was created to help offset assisted living, skilled nursing, and home health care for veterans. And the costs, again, as we know, can be as much as $4,000, $6,000, maybe $8,000 a month for a nursing home. And families say, how can I take care of my spouse? How can I take care of my parents at home without going through all of their investments, without going through all of their assets and having to sell their home? There's a better way. And that's why we have Scott Malik, who's a VA accredited estate planning attorney. And he can share with you how veteran aid and attendance will pay up to $2,200 a month for a veteran and a spouse, as long as you serve 90 days active service with at least 1 day during a wartime period. So if you're planning out your health care and retirement and you're a veteran or a widow of a veteran, or if maybe you have a parent that is looking at bringing in caregivers into their own home, or maybe you're making those tough decisions about moving your father to assisted living and you say, how are we going to pay for this? He only has Social Security and a pension. Veteran aid and attendance is something you want to check out. And all you have to do is call our office and say, I'd like to go through a VA intake. Then your next step would go through a VA intake, which is a 30-minute meeting with Scott Malik, the estate planning attorney who's VA accredited, so that he can explain to you all the qualifications for veteran aid and attendance and what documents that you need to collect before you go apply for this with the VA. Again, give our office a call at 1-800-848-8768. And when you do, leave a voicemail that you want to go through a VA intake, that you would like to schedule your 30-minute VA intake to make sure that you or a loved one is eligible for veteran aid and attendance. Again, that's 1-800-848-8768.
You know, it's impossible to predict where the market will be when you actually retire. So when we come back, Andrew's going to talk about how you can handle all those variables. So when we come back, we can talk about how your plan can handle all those variables. That's coming up next on What Your Money Would Say. Thank you for listening to What Your Money Would Say with Andrew McNair. He's president and CEO at Swan Capital right here on the Gulf Coast. Andrew creates written retirement plans for retirees, and he is here to guide you about retirement to help you get through all the obstacles you might face in retirement. We're talking right now about just retirement unknowns, things you need to be aware of. Another one that's impossible to predict is, whether the market's going to be up, down, or sideways at the actual time you retire. How do you build a plan for good markets, bad markets, and everything in between, Andrew?
Well, we talked about it earlier, but it's making sure that you give your money a job, your money an objective. And so many times families mix all their money into one pot. And what I mean by that is they have some money that is set aside for the first few years of retirement. And then they have some money that they hope that grows. And they have some bonds over here. But they're not giving their money certain jobs and objectives. And if you have a bucket that we talked about earlier, that 10 years and beyond income bucket, that bucket we should be taking additional risk, because the market will go up and down. That's going to happen. It's going to go up and down with the tides, and we have to make sure that we're well diversified. We have a long-term outlook, and we have a pot of money that is growing for the long term that keeps up with inflation. Because one of the biggest risks right now is when we're seeing double-digit inflation like we are now. If we don't don't have money that is having an objective or a job of growing long-term in real estate and stock market investments and private equity, that it has a chance of making double-digit returns to keep up with inflation, we're going to be left behind over time. So yes, we can't predict the volatility of the stock market. Only fools try to time the market from 1 year to the next. But we do want to have a long-term outlook and try to take advantage of that long-term buildup in the stock market.
All right, so when things do get rocky with the economy and things are fluctuating, obviously anxiety sets in for, I think, all of us. You, though, have a way of guiding your clients. So I want you to explain how having that plan can help us avoid making emotional decisions when we begin to feel a little uneasy about the world around us.
Well, certainly. I mean, market volatility is going to happen. We saw that in March of 2020. And as you know, we talked about on the radio show, what do most people do when they have market volatility? They're told by their advisors, they're told by their friends that they should stay the course, don't do anything. And that's so sad, because if that family had a financial plan, like all of our clients, we want to make sure that they have not only a portfolio, but they have a retirement plan. When we sit down with our clients, when there's a market pullback, we look at it as a buying opportunity, because again, we have money set aside for those first years of retirement. With that bucket that is the 10 years and beyond, we want to take additional risk. And when we see market pullbacks, we want to use that as a buying opportunity. So again, if someone ever tells you that you shouldn't sell anything when the market goes down, that you shouldn't take action when the market goes down, to stay the course, unfortunately, they may be mistaken. We tell our clients to sell things. We tell them to sell CDs, cash equivalents, bonds, to buy more stocks while the market is potentially on sale. Because again, if you have a long-term market outlook, we know that the market will recover with enough time. Now, when the market gets heated up like it is right now and is potentially overvalued, that's when we want to slow down. We don't want to speed up into the storm. We want to wait for that storm to arrive, then we want to drive straight through it faster.
I love that. Yeah, that's so good. Because a lot of times we do, that sign, stay calm and carry on. So
Exactly.
I love that you can actually kind of hold the hands of your clients and help them out. Let's get into the taxes right now. We have no idea what tax policy is going to be in place when we retire. So how do you help plan for taxes in the future?
Luann, when we make tax decisions about the future, the unknown of what lies ahead, we have to look backwards, because history does have a tendency of rhyming, as Mark Twain once said. It doesn't repeat itself, exactly, but it sure does rhyme a lot. And so if we look at history, and this is really important to write down, if you have a pen and paper, I'm going to share with you some really interesting dates and some percentages that you'll want to write down. So in 1913, the federal income tax was created. And it was created as a temporary tax to pay back the Spanish-American War. Exactly, very temporary. 100+ years later, very temporary. And here's the joke, is that it was only to tax the rich. And that sounded good at first, so everyone's like, well, I'll vote for that. It's only on the rich. And that didn't last very long either. And then it started being taxed across all citizens like it is today. And here are the facts. The top marginal tax bracket today is 37%. So you might be saying, well, Andrew, I'm not at the top marginal tax bracket. True. But I'm going to share with you a trend line, because if you're at the tallest bracket or the lowest bracket, you're going to still feel the same trend line. So if today the top marginal tax bracket is 37%, when families ask me, Andrew, do you think tax rates could go higher? I say, well, look at the average. The average federal income tax was 60% on average for the last 100 years. And it's been 90% 14 times in U.S. history. So can tax rates go higher? Yeah, they can go higher. And if you're not preparing for that, then we run the risk of not being prepared when it finally does happen.
Wow, that's a great explanation there. Really, truly. 90% 14 times in history.
It's crazy.
That's crazy.
We never see those days.
Right. Well, thankfully we haven't, But all right, so obviously taxes is a huge thing that you address when you're helping someone plan out their retirement. And I think that's one thing that a lot of us don't think about too much, but every time we pull money out, we're creating a tax event. Explain to us how you take your retirees through your SWAN sleep study, and you do include a tax strategy for that.
Absolutely. So one of the retirement report card grades that we give is on tax planning. And we sometimes give families A's and B's and C's. And you have to ask yourself, if tax rates potentially go up next year, because I know Biden wants to raise taxes in 2022. He's made that very clear that he wants to raise taxes in next year. If you have IRAs and 401ks as chess pieces on your chessboard preparing for retirement, what if tax rates do increase? You don't want to see some of your chess pieces be pulled off the board by the way of taxes, by just Uncle Sam raising taxes. Even though you've been growing your IRA and 401k all this time for retirement, and they decide to raise taxes, they're going to take chess pieces off your board, and you're going to be playing with fewer chess pieces because you're going to have to pay higher taxes when you take that money out. And that's why we give sometimes families a C in tax planning, because they are doing tax preparation with their CPA, but no one is putting together a tax strategy and a tax planning to make sure we're shifting from qualified assets that have never been taxed, to tax-free investments, i.e. like a Roth IRA, municipal bonds, anything that grows tax-free. So don't do this at home. If you're looking at Roth conversions, beware of the additional tax withholding that could be due, higher Medicare premiums, higher taxes on your Social Security. This is not something that you want to do it yourself, because there are so many nuances to actually doing a Roth conversion. Give us a call. Give a financial professional a call that specializes in working with your CPA or working with CPAs so that they can help you build a tax strategy of shifting assets to tax-free retirement over time. By giving us a call at 1-800-848-8768, we can go through some of those tax strategies with you one-on-one. It's a 1-hour complimentary visit that we like to call our Swan Sleep Study. So again, that phone number is 1-800-848-8768.
Check them out on their website too, swan-capital.com, SWAN-CAPITAL. You're going to find some great information there about Andrew and his team at Swan Capital, and they will guide you with your tax strategies in retirement. Obviously, each of our goals is to keep our own money in our own pockets as much as possible. So anyway, we thank you so much for listening. This is What Your Money Would Say with Andrew McNair. I'm Lou Ann Fulmer. All right, so we do talk about having this window of opportunity right now to try to keep our taxes lower in retirement. You just touched on it right there, Roth conversion. I want you to go into that, please, and discuss what that is.
Certainly. So a Roth conversion is taking money that's in an IRA or 401k, any money that's never been taxed, and shifting it to something that's tax-free, i.e. like a Roth IRA. And a Roth conversion means that you're paying the taxes now. But the beauty of shifting it to a Roth IRA is it means that that money will never have to be taxed ever again. It grows tax-free, you can withdraw it tax-free, and it transfers to your spouse and children tax-free, which is something that a lot of times families don't even think about, is that when they pass away, their spouse goes from filing jointly to now being a single taxpayer. And in this country, sadly, we make actually single widows pay more taxes because their tax bracket just shrunk. So we want our spouses to have tax-free investments so that if something happens to us, they don't pay more taxes when we exit the picture. We want them to pay less. And so that is one of the reasons we talk about Roth conversions with clients. The other thing that we're talking extensively right now about is if you have money that is in emergency savings that's above what you need. So if you have $30,000 to $50,000 set aside for emergency savings, but you have more than that, maybe you have $200,000, $300,000 that's just sitting there in cash equivalents, but you're not ready to get into the stock market just yet. What we're helping clients do, especially the ones that are still working, is we're saying, why don't we take money out of your paycheck? Maybe drop your paycheck in half. And you say, what do you mean drop it in half? By putting as much as we can into your Roth TSP, your Roth 401k, and your Roth IRA. And even though we dropped your check in half, where you can spend down your savings, your money markets that you normally would have a larger paycheck, you'll just have to dip into that money market and that savings, because what we want to do is redistribute your money from the right hand that's taxable, that's not earning much interest, to your left hand that's tax-free, maybe in the stable value fund or the G fund in your TSP, so it makes it a little bit more interest and it's all tax-free. These are just one of two strategies of many strategies that we can employ when we talk about tax planning with a family.
So if we haven't planned for some of these big unknowns in retirement, what advice do you have?
The first thing you should do is cut yourself some slack. We live very busy lives, and tax planning is probably not high on the list of things to do most of the time. And many times families have a professional, but sadly they don't have a financial plan. And it's no surprise that when they meet with their broker and they're just talking about the investments, it's a surprise when they listen to a show like ours, Luann, and they say, I never have talked with my broker about tax strategies or estate planning. Again, that's not your job to give advice to your advisors. It's, in fact, their job. And so a lot of times we just first off need to cut ourselves some slack because we live busy lives and we depend on professionals to help us. But that's why we created our Swan Sleep Study. It's to give families a second opinion, to say, is there another way that we can do a little bit better? Can we tweak or make an adjustment here and there that makes huge impacts for your retirement? And one of those ways that we talk about are tax strategies, such as Roth conversions, or we can look at shifting money from taxable accounts to tax-free accounts. One of many strategies that we can employ for families. So give us a call to go through that Swan Sleep Study, which is a 1-hour complimentary visit, and we'll spend 1 hour answering all the questions that you can come up with, but also sharing with you ways that you could potentially do better with your financial plan. So give us a call at 1-800-848-8768. That's 1-800-848-8768.
This is What Your Money Would Say with Andrew McNair, and we'll be right back with the rest of our show. Hi, you're listening to What Your Money Would Say with Andrew McNair. I'm Lou Ann Fulmer, and Andrew has appeared on the Fox Business News, also Market Watch, regarding financial planning. So today he's here sharing with us his wisdom about planning for your retirement. So, some things are more fun to plan in advance. We always talk about retirement planning, vacations, weddings, but there are some other things that are just as important, but maybe a little harder to plan. And I'm talking about your final wishes, even your funeral. It's kind of hard to buckle down and do that, but it would be so much easier on your loved ones. So, Andrew, I imagine all of us have kind of experienced the pain of trying to deal with funeral arrangements on top of our own grieving when a loved one dies. It's not easy to do. What have you learned from your own personal experience with that?
Well, I've had to live through countless other people's lives. With our clients' lives, I've watched families that have done the pre-planning ahead of time. And I've watched families that didn't do any pre-planning. And it's sad to see the impact that a lack of pre-planning does to a family. It can truly make a family split apart, to not talk for a decade because of the funeral arrangements were not planned ahead. They weren't in black and white. And unfortunately, families feuded over that. And brothers and sisters became more like enemies, sadly, over just what hymn was going to be sung. And it shouldn't be that way. And I luckily had a great example. My grandfather knew that his time was coming. He was 93. My grandmother had already passed, and he was always a planner. And he didn't want any of his family to not speak after his funeral. So what he did is he made sure all of his legal documents were in a row. He got that done. He got this trust and his legal documents all put together. He made sure his investments were prepared properly to go to each of his 3 children. He even, Luann, had a color code, 3 colors, where they could put little dots under each thing in the house that they really cared most about. Like if they wanted the stamp collection, they could put a little dot on that. And I thought, how awesome was that my grandfather thought ahead, because I like to say that only a fool doesn't prepare for an inevitability.
Yeah.
We're all finite. And so if we know we're not going to be here forever, we have to prepare for our exit. And I know that sounds morbid and maybe that's tongue-in-cheek, but I thought that my grandfather did it really well, because My aunts and my father, they all speak. They still have a great relationship because I believe that my grandfather planned ahead.
Right. That's amazing. He kind of followed everything that AARP says we need to be doing, the basic things to get in line. Sounds like he really just followed this. I want you to go over this. We have this list in front of us. Tell us some of the things that we can consider doing.
Yeah, this list is really helpful. The first thing is make sure you have your life story down. Don't leave out or don't leave it to your family what they are going to put for your life story because they will leave out details. So don't leave it up to them. Your spouse might not remember all your career achievements, and your kids might not remember what year you graduated from college. You might not mind the typo, but it would be nice if you had your life story written out of, here's how your life has turned out. And I think it's really cool to see like all the things that you've accomplished over a lifetime. So many people are hard on themselves of what they've accomplished, and you look back over your lifetime and you're like, hey, I've accomplished a lot. Every chapter had its ups and downs, but there's great things.
Yeah.
Second, burial plans. Don't make your family guess on how you want your final resting place to look like and what casket you would like, or if you're going to be cremated. Don't leave that up to chance. Service preferences. Back to the favorite songs and hymns. You want to make sure that if you want a poem read, that you give it ahead of time to your family by putting it in with your legal documents. Email list. A lot of times people say, who are we going to invite to my dad's funeral? Well, if you say, hey, these are people that I really want at my funeral, and here's some people maybe I don't want at my funeral, it's really good to make sure that you've done this pre-planning for your family so they don't have to go through so much of the hard and heavy lifting to do it.
Right. I just think that is such a great idea. This has kind of incentivized me to start doing this, I want to kind of do that, add the songs. I'm starting to write down my favorite songs, Andrew, what I like. And I need to, though, like right now, I'm just kind of writing them on my phone, in my little
just
notes.
Because you write them down doesn't mean you're going to die tomorrow.
No, I know.
I think so many people are so like superstitious,
Exactly. No, but I need to actually it says here, put it on a digital thing. One of those little things. But I don't know. I might just write it all down, old-fashioned, in a folder.
I'll just make a Spotify playlist. This is my funeral procession.
My husband would die. Ha ha. He would die laughing if I had, here's my list for my funeral. That's pretty funny. But anyway, this is all part of your process. You take everybody through all the fun things about retirement, but then also you talk about estate planning, legacy planning, estate planning. So tell us about that and how you guide your retirees even with that.
Sure. I mean, it's really unique that we have Scott Malik. He's an estate planning attorney in our office. We work with many attorneys, but Scott Malik is in our office. And what's really nice is if you already have a basic set of legal documents, maybe you already have a will, a power of attorney, a living will, and you came down here from Virginia. And when you came down here, you've been told by multiple people that you need to redo your legal documents. I've watched Scott sit down with families, look through all their legal documents and say, no, actually, you don't have to redo anything. These documents look really good. And I'm sorry that someone told you that. And that saves that family thousands of dollars potentially of redoing legal documents that they had no business ever redoing. They were fine how they were. And I think it's really nice to have Scott there because he can not only help families that have legal documents, he can help those families that haven't done that pre-planning yet, that don't have a will and don't have a power of attorney or a trust. He can sit down with you, diagnose what your needs are, and then say these are the documents that you do need for your family. Now, if you're listening, you say, Andrew, that's exactly where I'm at. I don't have my legal documents done. Or maybe you're saying, that's me. I moved here from New Jersey, and I'm not sure if I need to redo my legal documents. Scott offers a 1-hour complimentary visit alongside ours. So what happens is when we sit down for our 1-hour sleep study, and we're going through your retirement planning to make sure you're prepared for retirement, he will actually sit down and review your legal documents while I'm doing my job. He can be doing his, and he can make sure that you do have all your legal documents in a row. If not, he'll tell you, here's some things that you're missing, here's some things that you want to make changes on, and then you can decide if you want to hire him or hire someone else to actually take care of that. And he charges $0 to do that, which is really awesome that he does that as a complimentary part of our Swan Sleep Study. So give us a call at 1-800-848-8768. Again, that's 1-800-848-8768.
Their website, swan-capital.com. You can find out even more about them there, swan-capital.com. Andrew, would love to help you not only retire well, but finish well as well. This is what your money would say. I'm Lou Ann Fulmer here with Andrew McNair. So, all right, let's get into funeral expenses. The median cost of a traditional funeral here in our country is $7,500. So what are some ways to plan for those costs ahead of time?
Well, and it can certainly be a lot more. So that's why we definitely encourage families to go to their bank today, sometime this week or weekend, and make sure that your bank accounts have POD on them, payable on death. So if your checking account, savings account, money market are at one bank or two banks, make a visit to each one of those banks and confirm that your primary beneficiary is your spouse. If your account is not joint, if it's not a joint bank account, you want to make sure your spouse is primary and your contingents are your kids or your nephews and nieces. If it's already joint, you want to have your primary beneficiaries, your kids or nieces and nephews, and then the contingent then would be maybe a charity. If you have that payable on death and they show up with the death certificate, they're going to be able to pay your funeral expenses. They're going to be able to pay all of your bills because now they're the new owners of those checking accounts and they can pay the bills that need to be paid after your passing.
Yeah, I remember that happening with my dad. My oldest sister was the one in charge, and so she had to do all of that at the end.
It really makes things easier. The next thing we definitely want to cover is veteran benefits. If you were in the military, you can be buried in a national cemetery with no charge for gravesite or marker. You'll need to pay for funeral services like embalming and burial, but the Department of Veteran Affairs will pay some of those expenses. And that's great because if you look at some of those grave sites, they're beautiful. I mean, Barrancas is a beautiful cemetery. The amount depends on how much they'll pay based on whether your death was service-related or not. So the next thing you'll want to know is you could look at borrowing or getting a loan, but interest rates can range really high. That's why it's very important to make sure you have payable on death on all your bank accounts so families don't have to borrow to pay for those funeral expenses. Or you can go ahead and prepay at the funeral home. There are prepaid plans available at most major funeral homes, and that's really nice because you can lock in that cost at today's prices. So if things do get more expensive, you're locking them in at today's prices.
Andrew, sometimes you are one of the first people contacted by the family after a client passes away. So tell us, what are some of the things you go over with the spouse or the children of a client who has just died?
Well, it's one of the greatest honors to be that first person that people call. I'm definitely always on the top 5. I know that. But it's really encouraging when we can tell families, hey, you have nothing to worry about. What you need to do is go grab that blue binder. And when the time comes after the funeral, give us a call. And they say, is it that simple? Is everything in the binder? I say, everything's in the binder. And that's what you and your family need, is a binder. So for every client, we put together a binder that has 2 years of tax returns because dead people, unfortunately, have to pay taxes still. It has all of your legal documents, your will, your power of attorney, your living will, and as well as a trust maybe is in there. It has all of your investment statements. It has all your insurance documents all in one binder. And that's what we prepare for every family so that when their family finally does call us and they say, hey, Andrew, my mother has passed, we tell them, grab that blue binder. Come see us when you're ready, and we'll go through the binder to make sure that we have this transition over to the beneficiary seamless for you and your family. And so many families have said, Andrew, thank you for making this easy. And that was the promise I made to their parents, is that I would make it easy for them. And so we're just fulfilling that promise that we made years prior. So if you're listening, you say, Andrew, I don't have one of those binders that have all my legal documents, financial documents, and insurance documents in one place. I need to get that done. How can I have that done? We can help you with that and give you the list of things to actually accumulate and put in your binder by just calling and scheduling that 1-hour sleep study, which is a complimentary visit to go through your retirement readiness to make sure that you finish well. So give us a call at 1-800-848-8768. So I want to thank you for listening to What Your Money Would Say. I'm Andrew McNair, and I want you to join us next week to help you unravel the right things that you need to do for a successful retirement. Again, that phone number is 1-800-848-8768.